So key data point, we have over 600 videos in YouTube. And from there, about 130 of them, or roughly 130 of them, we published it. So I was looking at with our database, we have 600 webinars. That is some crazy amount of numbers. It's interesting. Anyways, thank you, everybody. I really appreciate you joining. We are redoing our invite program, our emails and things like that. So tech-wise, there's some shifting happen. So we're losing quite a bit of traffic on that one. But thank you for joining. And over time, the traffic should go up as you're gonna go through. Okay, so Tuesdays actively active. That's the topic. Trevor, you wanna kick it up from here? Then we can
Yeah,
go.
so thank you. So as Shar mentioned, we do this every other Tuesday. And then we have a ladies. We're going to be doing some rejigging, as he mentioned. So this one is Transformational Tuesdays. And so to last week, or 2 weeks ago, last 2 weeks ago, we had technical difficulties. 2 weeks before, we talked about actively passive. All of these are on our YouTube channel, and I'll share a link where you can go back and watch past episodes. So today we're going to be talking about actively active. And I know that sounds like two double positives or whatever, but there's a big difference, right? Because even if you're a passive investor, you still have to do some activity. And certainly if you're an active investor, you have to do some activity. These are educational series. So we do is we try to present what we believe is to be true, what we believe is to be accurate. You always need to do your own due diligence. At the end, we always have plenty of time for Q&A. Don't be shy. Even type a question in the chat anytime. We're always happy. We may not stop and answer it, but I don't think we've ever left. And you got to think about it. We've done this like 120 times. I think we've answered every question every time. So it's all about learning for here. So we're going to talk a little bit about understanding the cycle, mapping your investment strategy. We have a special invite and then always time for Q&A. So if you fail to plan, you are planning to fail. Think about that. That is pretty ominous statement, right? So you need to have a plan. And again, what we try to present on these Tuesday nights are what are we doing? Why are we doing it? What sometimes or others are doing. So we really try to take a holistic view so that you can take with information you learn on these calls and put it into action in your own investment strategy. So a little bit more about Massive Capital. We're a vertically integrated real estate company. We're also a developer of Class A retail and town centers and an owner operator of value add multifamily. You can see we're very Texas focused. Most of us live in Texas, but we do have assets in Denver, Colorado, North Carolina, and Georgia. We are also partnered with Realty One, mostly on the development side. And we have between the two of us, $500 million of assets under management. So Massive Capital has just under 1,400 apartments. We've got a lot of different retail. So we do LP equity for retail and family office. We do triple net leasing brokerage, land development, steel frame construction, and then, of course, we have our massive master's program, which is if you really want to become very active. We'll add very in front of that.
Again, Trevor, I can add. So for the market cycle, Trevor, thank you, by the way.
Yep.
From the market cycle, Oak Tree Capital, he is the founder of the Oak Tree Capital. Pretty awesome guy. Study him as much as you can. Howard Marks is the OG of cycle, and he always talks about investment success doesn't come from buying good things, rather buying things well, right? It's not buying good things, rather buying things well. It's very important to understand the distinction between it. I bought a good asset or I bought an asset well. That's the difference of it as you kind of go through. So we're going to use Howard Marks a little bit more today as you kind of go into the market cycle and what is it that we try to do. This is the second quote, Trevor. As I was looking at it, man, I was having a good time reading at it. Right, there are old investors and there are bold investors, but there are no old bold investors.
That is a funny one.
I was laughing at it. I was like, yeah, true. I mean, early on, we all are bold. He got it. It's a slam dunk. We're going to do it. Da, 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 da. And, after that, we got some reality check. Then we became old and not so bold investor. So everything is painful. Everything is too much work. Everything is too mumbo jumbo. So take your time and do the right thing. All right. So this one is one of the coolest things that I always remind myself. There are old investors and there are bold investors, but there are no old, bold investors. I think, Trevor, you kind of laughed at it. It's the same reaction I had when I read it.
It's true.
Right.
I
So
think I'm still old and bold though, but maybe because I've only been doing it for 6 years. But
I,
I'm not sure how bold really, but we'll see.
I'm not bold. I'm not no old and bold. So I am very gun shy. But when the time comes to pull the trigger, if you know that's the right deal, and we can buy something well, go do it, right?
Yeah.
All right. Joking aside, let's get started. So that's Jasmine out there. Jasmine, our investor relations. Almost all of you guys know Jasmine. So if you have touched any of our webinars and you have seen Jasmine, she also runs the She leads the She program for us. So go to the next. Cool. All right. So what we're going to do on the CRE side, what we call it, if you don't know how the equation works, plug a number and see where it goes out. And then you can kind of over time learn, right? So in the investing side, to think about it, there are two options. Either you're actively passive or you're actively active. We don't believe in passive, completely passive. There's nothing completely passive. You are here. If you're investors, you are learning. You're actively seeking out sponsors, you're actively underwriting it, you're actively looking at deals, then you're deploying a fund. By the time you go through all this, you're really active, but you're taking a position on being a passive versus active. So our goal here is that showing you the difference between passive and actively active, and introduce some of the more stuff as you kind of go through. So you can be a strong passive investor, or if you choose to be active, you can be a strong active investor. I'll let you read that, right? That's a classic definition of risk. Risk comes from not, you know,
Sorry.
the risk comes from not knowing what you're doing. That's the classic definition of risk, right? In other way, if Trevor have invested 50 deals, you know that deal is going to look like. He has done it quite a bit. I've done only 10. I don't know. So just because I've done 10, he has done 50 hypothetically, then I have a lot of unknown knowledge that inherently has a risk. So I always remind myself, just because a builder can build a house, I can't build the same house at the same price, the same way for the first time if I got in the first one. So there's a lot of learning and that has to go through for us to get to the point. Okay, so market cycle, right? Some of you guys have seen this chart. I updated that a little bit, so let me kind of go back and 2021 too, and then refresh your memory a little bit. That where the risk comes in from not knowing what we're doing, right? 21, 22, we're on the top of the cycle, as you know. 23, 24, everybody was in a panic mode, and last year was at the bottom cycle of it, right? In 25 we passed the down cycle. So tornado ended, damage is still happening, and then which is this year, all the loans and everything else that's going to go through. So by end of this year, we're going to be out of the tornado that we have, and that's where this 25 comes in. Now, if you look at it, this is the worst time to buy. Oh, sorry, every cycle is a buying cycle, not the way you buy it. So this is one way of buying assets. This is another way of buying assets, and this is in between, and this is going up, right? So what we call it is, this is our risk matrix. From the loan perspective, we have different kind of loans: fixed loan, then floating, then bridge, then a prep. Refresher for everybody, right? Whoever invested in multifamily, when the upcycle happens, when you are on the top of the cycle, you should buy products with less debt, which is fixed and not fixed, all this other stuff, right? But what happened? A lot of folks are new here. They ended up buying the other way around. We levered up as much as we could during the top cycle. So when the cycle happened, we paid the price. Now, if you flip the coin, we're in the down cycle, tail end of it and getting out. We should be leveraging up, right? Buying products as much as high as you can pay with interest rate. And guess what? Some of us are buying on the other way around. If there's a survey, it says how you're underwriting. I think almost 65-70% of the market is saying we're underwriting with a fixed debt. You as a finance guy or finance team looking at it, and you're asking, why would you underwrite at a fixed debt in today's market? Because this is the worst you can get. Think it's better from now. So ideally, we all should be taking as much leverage as we can, assuming we know the definition of buying well. That's the definition of buying well on the finance side, and we understand the operations capability on it. So thinking it through a little bit, and from the academics perspective, and then you go. Example, right? Let me give you some data. Easing at the global level. So I took down the snapshots everywhere. If you look at it, 2025, we believe we have some optimism. We're going to go through a soft recession and the job cuts and the GDP cut. Then we're going to come back out on the tail end of it. But then if you look at the globe perspective, almost all the central banks, they are ready to loosening the monetary policy. So they're ready. We're not going to have that many rate cuts today, but system is priming up to a point. It is happening, so we're ready. So 25, it's a good year for everyone to be active as much as you can, because we are at the down cycle here, and whatever problem the up cycle happened, we corrected this year Now you come in and you go. That also means that conventionally we think about multifamily only, but there is a life beyond the multifamily, the retail, office, not so quiet, industrial, hospitality, and special purposes. So if you're honing into one angle, understand that having a one strategy at a certain time is tough. If you're a multifamily, we underwrote that with a 20, 30, 40% equity raise. Then we bought a $50 million deal. In today's market, that's one of the toughest things you can do, right? If you're underwriting at a self-storage, last 2, 3 years was fine. But self-storage price dropped to that because of the revenue went up, keeping the economic occupancy the way it is. So having one strategy is great. If you're skilled, you can bolt on, but you need to have multiple strategy within your domain so you can buy depending on what the season of. So for us, we invest in retail, invest in industrial, invest in RV, and a park, mobile home park, land, and multifamily. So it's all about creating a value when you look at it. So our ask is that, hey, everybody has a constraint, which is your time. Everybody has a unique position, which is your skill set. If you couple them together, then you look at those different segments and you pick and choose whatever asset class you fit. Just don't follow the crowd blindly all the time that, hey, I have to go residential. And then once I do 10, I don't know, 2, 3, 4, 5 flips, I can go buy 50 units. Then I'm going to go buy 100 units. Everything has a time and a place for it. And in between, there's a lot more. So we want you to kind of think about life beyond the multifamily and other asset classes that we have. Deal flow side, just to kind of let you know, the last year we had quite a bit of deal flow, lots of deal flow from the massive side. And we look at multifamily, mobile home park, RV park, self-storage, land, new development, flex space, mixed use, retail, everything else. Right now we have 2.5 property under contract. Half means one is like halfway through. Or one in new construction retail, one in a flex field development, one apartments. Again, we're not raising. This is purely from education. We're just sharing some data points. Last year alone, we looked at about 1,000+ deals. Almost good chunk, almost 1/3 of them have been repeat for the last 2 years. And whatever we have seen, everything is coming back now. So we're seeing very less deals that are coming onto the market, which wasn't on the market last couple of years. But the whole point is it's a fun market. It's a lot of things that happen. And then for you to kind of get ahead and be a good investor, either way, passively or actively, you have to spend some time on it as you go through. A little bit more for us, underwriting, acquisition management. We look at data from the research, we look at the transaction history, we look at the asset management, and we do the investor relations. You guys got the text and the email, it's here. If you're an investor, you get our update, and we closely pay attention to who is transacting where, and we do a lot of research. To do that, we have a data warehouse. We use tons of systems, tons of process, because ultimately, even though you're actively passive or actively active, you got to ask the question, how do I do deals, right? Give me 1 second real quick. And again, when you do the deals, it doesn't matter actively active or passive, you need to have a team behind you. Remember, depending on the type of properties that we buy, either it's a commercial, $2-3 million, or upwards to 20, 30, 40, $50 million or so. It takes around 2 to 5 years to cycle a commercial deal. So whatever that we do, it's going to take a little time. And for you, you know, the whole team. Again, this is a lot. It's going to be on the YouTube. You can take a look at it from deal sourcing to capital to balance sheet to investor relations to asset management and refi exit. Nobody's going to win by themselves here unless you buy 1 or 2 assets for every 5 years or so. If you want to grow both, and if you want to make sure your money is protected, especially on the downside, you need to have a team that they are actively looking into deals in any market cycle, so you can really make sure that they understand the game. And so when that asset shows up, they get to say, this asset can be purchased at X dollar amount, and then it's a good buy, rather a conventional way, right? So we always say there's a roles. If you have a job and you are busy, you love what you do, you can come into a team, maybe and you do a JV with somebody. And if you're a broker, you have a running business, you have a relationship, you want to buy a deal, you can maybe on the deal sourcing. And if you're an existing asset and already you run it, you're a finance person. I'll give you some example. Or you're an engineer and you want to run an asset on your text without doing much of an operation, you should look at something else. I have an example for you guys. So the whole point is, this is a map of the life cycle, everybody that you need to do a deal. Now you ask the question, where do you fit in and how you want to add value? And then over time, you can optimize as you go. So ideally, when someone starts new, they're bold, they want to do everything. And when you get old, you know your expertise. And you kind of say, hey, I don't want to do anything but one. That's the beauty of balancing act here. But you don't know unless you get in it, right? So our ask that these webinars at the starting point, then you go hang out with the folks who are doing deals all the time and look at the deal from the backwards, which is the ownership perspective. All right, and this is my tagline. But look, we can go to YouTube University, we can come to the webinar, you can get the template, but you can have it all, but it's not going to get you in the winning circle. It's just tough, right? If you're busy, it's just like, how should I say? If you are a medical professional, you're a doctor, you're in a surgery room doing surgery all the time. People can look at it from outside, but only people come through the door who are adding value to the surgery, right? So, number two, it's kind of real, right? Life is unfair. That's what I tell my kids. But so is commercial real estate. But number three is very important. How many of them you can put on yourself? Life is unfair. I'm 6'2". I'm not. It is. I'm who I am. When I go run a high-speed run, then I'm not the guy to cut out for it. But guess what? If I can change the game, I have odds of winning more, right? So we always say the same thing for the real estate. You can come to the real estate game, but if you don't have some of the unfairness working on your side, either from the deal finding, for the tool, then a process or relationship, only thing we're going to be end up competing on is the price. And that's the worst thing you can do. So how do you get started? Simple thing, commercial. You can come in as LP, limited investor. You can come in as a general partner, or you can do JV and a solo. Solo, don't recommend it. You can always do JV. I'll give you some JV examples as you go through. But typical syndication is the sponsor, LP, and general sponsor. So that's how. So if you look into deal and you say, hey, where do I fit in? You start from the top and you say, hey, I could be an active and actively passive on the LP side, and then I could come into a general partner role, or I want to be a little bit more than LP, but I don't want to syndicate. Then you can be a JV structure. You can get 3 or 4 people, call them up as you kind of go. So most of the time we talk about the syndication model. Today, I'll talk about a couple of JVs, and I'll show you that that's also a way to kind of come in. That's JV model. It's in between LP and a GP model. So you can use a type of syndication to do JV structure, but there's also a good way to come in to multifamily, non-multifamily, into commercial as well. So that's the way we started. And we always keep on asking question, hey, we must have a competitive edge. What is the edge? What is the edge? And to me, it's sometimes it's how and sometimes it's who. When you want to get started, it's more of a who, less of a how. And over time, it's more of a how, less of a who, right? So who you know, which team you're hanging out with doing it, which process are you following, and who can get you a shortcut, which is who can hack your way into the whole thing, who can give you the HOV lane to get to downtown on time without paying much of a toll. That's the way. And you should take a look at it, especially in today's market. We would not say that on the market was hot because everything is competitive, extremely competitive, right? But in today's market, sponsors, everybody, the good players are winning today, and they're much more level-headed. The asset that we're buying, it has a much more stronger footing. They have bolder assumption, a solid assumption that kind of goes in. So deals are coming out to be good. It is tough, but it's really, really good as you go. Okay, so on that note, I'll switch the topic a little bit, right? So I'm kind of tying that up, that why this is a good time to be active and how you can be active. And then let me give you an example what the activeness look like. So today I'll talk about FlexSpace. So this is the property we own, Duncombe. Do we have an engineers, finance goes here? Or anybody, technical, non-technical? Okay, well, maybe you can type in one in the chat and we can see it. So, all right, so let's take a look at the property. My wife will never get inside the door. I know it. She will not touch it. She's not gonna come close to it. She was like, not at all. But guess what? When I saw it, I was in love with it. I was absolutely in love with it. Why? Because that is a storage facility back then for a clothing sorting facility. And I'm an engineer. I did the inspection, 15 minutes in and out, couple of holes in the roof. That looks good. No fire, no damage, metal building. I was done. I looked at the lease agreement, what they had. That was a 6-year lease. There's a 3-year, 3% increase. Tenant isn't going anywhere, right? Ugly. I'm perfectly fine being ugly, right? Because it's a finance play. We played the finance. Market makes sense. We did it. And then bought it at a $650. We paid a finder's fee of $10,000 for someone who bought this deal. It's a single tenant, $5,500 a month. It's a gross rent, one check, call it done, 13%, 2 years gone. And then we realized right here, there's a small $5,000 additional track, which has a mobile home park. We split that out. We're selling it now. That's about $100,000. This building is all in 550, 50% loan, 13% cash on cash, one check a month. Life is good, right? It's not bad. I'm not buying a house, but underwriting that has 2 tiers. One, understanding the finance, the whole lease agreement in place. That's where we understood that this is a good tenant. It's going to be here for a long time. He was there for the first year and a half, then he moved out. And now the current tenant, he sells printing machine parts. He ships it out from US to other countries. This is close to Port of Houston. He's been out there for almost a year and a half now. So that's one way of coming in. Now, if you have a W-2 or if you have a business, you like it, you're busy, 10 hours there will make you more money than over here. What you can do, you can find one or two partners, buy one of those buildings. If you need a tenant, text somebody. The broker will do the tenant. Renewal, broker will do renewal. Repair, tenant pays for it. You just get a check and it's done, right? Simple. Let's look at another one. This one. This is even more complicated. So let me give you the story. That place had bad smell. The smell was bad, especially when you walk into this side. Okay. And if you come on the back side, it is dirty. It's like a 2-inch stick of black and black dart out there, right? And again, when I saw it, I was in love with it, right? So I'm a downstream guy. I grew up in a refinery, did a lot of projects. I bought that right at the tail end of the COVID. This is a special valve manufacturing company. So on the process piping, they make those 8 inches valve. That's what they do. And special means that this is a custom design valve. That means you cannot outsource that to China or India. It has to be locally made. And those are all custom. That means if a refinery says, I need it, they really needed it yesterday. So they always charge a premium and they make money during the COVID time. On the flip side, during the COVID time, I was at the Shell refinery. We shut down every single capital expense as much as we could. Like we shut it down, $300 million, $400 million came to pause. They still made money. So when we saw that from the finance perspective, I was like, okay, I love the business. I get how the business makes money. They have a long-term lease in place. This is a cash cow. So during the COVID time, we all bought whatever we bought, but we bought this one in the middle that we hooked because we saw that, hey, I was working, text, tenant. This is the first time ever in my life when an accountant called me on the third day of the month and he said, Shariah, did you get the rent check? You know, how cool is that where someone calls you, I don't call the tenant, they call you to make sure that you receive the check, right? So what it is, we bought it 2 buildings for 1.25 million. We paid $13,000 for a fee. And then we sold it for 1.7 right at the COVID time, almost $500,000 profit less. Now, this is another point, going back to the chart. And this is where buying well and knowing what happens, right? So we bought it here, like here somewhere, right? We bought that building here. And then we saw money was coming in. Once money gets published, it has to go through the system and has to get out. We knew inflation will happen. We just didn't know when, right? We're finance people. I pumped in $1 trillion. The dollar has to go through the whole market. It's going to create competition. It's going to escalate the price. It's going to escalate the competition. And then it's going to crash. It's going to come down. So we knew something will happen. We just didn't know when. So what happens is whenever we bought this asset, we cut a wing off it. I have a fixed 7-year lease agreement. When the inflation happened, my buying power of $10,000 4 years ago is not same as today. Think about it. What we buy today with $10,000 3 years ago, it could have taken maybe $7,000, $8,000. And once we saw that, we said, look, my $15,000 in 2022, in 25, 26, will be worth maybe $10,000, $12,000. We don't know. We sold it. We sold it as quick as you bought it. Even though it was a cash flow, it was a cash cow. We exited and now we're getting the benefit. So going back to the point, understanding the cycle, understanding the asset class, understanding your flexibility, then design your portfolio is very important. And I would not know unless I brought in the partner that I brought in this one. He got like 7 or 8 warehouses. He's looking at it. We're looking at it. And then when we saw that downturn was happening, we just got it, right? So going back that we need all need to hang out with the team. And so make sure that, we can really understand the cycle as a class. And so that's the beauty of, what we talk. Oh, by the way, this is essentially an expo. We have 3 days event that we do. We talk you through the entirety of the asset classes from all the different classes. And then we kind of say, hey, pick your asset class, pick 1 or 2. And depending on where you're at, like if you have a business, if you have a work, you don't have to directly make a hard transition into real estate. Build your way up, pick and choose what you like, pick and choose what you can, bring, where you can bring a difference. And then you kind of play with. Because I'm not a single family guy. I'm not a flipping guy. I flipped a lot, but I did it because, but did I enjoy it? No. Do I love this? Absolutely so. So going back, investing in CRE, you have 2 choices. You be actively passive or you be actively active. And then ideally, you should have a portfolio mix. What is it that you? This is all the things that we do. We talk about all this within our expo, which we'll share. But the whole point is go with a macro view and then build your portfolio. This is not the time where we kind of show up just because we buy one, then try to get the best out of it, right? back solve a little. So going back, let's take an action. What I would say, we have, I think, Trevor, if you want to drop a note to the link. So we have one website, you can apply for Expo. That's one of the websites. Some of you guys been there already. And then this is about 50 people for 3 days. We spend all together Friday, Saturday, Sunday, mostly invite only. So we look at every single asset class. We'll look at the JV model. We look at the syndication model. We have SEC attorneys that come and talk. We have subject matter experts who come and talk from different asset classes. We look at mobile home park, RV park, land development, triple net commercial flex space, multifamily, the BTR type deals, or ground up development, everything on it. And then you ask the question, okay, that's the all the different plays, and also self-storage. Those are all the different plays. And then we give you feedback on all the things that we're seeing. Then you kind of decide, okay, I think those two fits better because my schedule is this, or I have my balance sheet is this, or my equity is that, right? So you kind of mix and match it up rather just go one way, which is kind of very narrow path to go. All right, so going back, and I would say, I always say everything starts with you. Talks are free, ideas are dime a dozen. Unless we take the first step, it doesn't really go anywhere, right? So we gotta take the first step and move that forward. Same for you. If you're thinking about it, come into the play. It may not be step by step. You can get to 1, 2, 3, then maybe a little gap, but you got to make the jump. Otherwise, it's just tough. You'll be stuck. And if you're stuck in that mode, you look at that and you just come to the profile, fill out the form. Olivia will give you a call. We can kind of have a little conversation to make sure that you're the right fit. And then you come and hang out with us for 3 days. So that's all I had. I went rather quick. I want to open up a lot of questions. Then we can go from there. Oh, and this is another version that I kind of saved it. This is Sanjay. He went to Mount Kilimanjaro, what, 2 years ago, right? Year before, yeah, 2 years ago. And he took that as all of us, we do it. Whatever we achieve something, we go take the pictures as we go. This is the way world sees it, but this is the reality. This too went. It took 11 team members to take one team member to Kilimanjaro. So everybody that you see have done something, you ask the question, who's backing you up? You did not get there by yourself. It's just tough. And I believe this gentleman put together, they have climbed over 50 times. And he's like one of those. Sanjay showed up and he's like, I've been there 10 times, 50 times. And then they took him. But that's always the reminder of the massive capital, massive masters. It's the same way. It doesn't matter how smart we are, but if we're average and we get 10 average people line by line, we can have a lot of cumulative learning. That's alone, it's a differentiating factor. And that differentiating factor should create better economic value, compared to the competition or the other folks that that's why going back, it's very important to go back in and hang out, with the team that is doing the work, also understanding some of the other plays that we have, and then you kind of pick and choose what you want to do. But either way, 2025, it's the absolute best time to get started, both from the LP side and or the passive side. Our role is to kind of share all the different options that we see. So you get to see it too. All right, I'll stop sharing. Let's go for Q&A. All right. Yes, team does matter. That's for sure.
Yeah.
Team
If
does
it was
matter.
me, it would take 22 people because they'd have to take turns carrying me.
I mean, the little nuggets, right? Those the small nudges that matter. How do you source? Yeah. So from the master capital side, Sanjay, he's the first person. So we have a lead and a backup. Most of the operation side is me and Sanjay. So on the master side, we have a subject matter expert for mobile home park. We have a subject matter expert for RV park. Then a subject matter expert from the land development. We have 3 people that do it. Flex space, it's about 2 folks. Then we have assisted living. We have a subject matter expert for that. So we have different lanes that we can kind of cross-pollinate.
Okay.
Hey, Vanessa.
Hi, can you guys hear me okay?
Yes.
Yeah.
Okay, great. So I just wanted to ask, first and foremost, thank you so much for all of the knowledge. Learned a lot and loved it. Thank you so much. And second, my question may be a little bit biased, but I was wondering if you have ever considered integrating like philanthropic efforts into the business endeavors you guys have. Like for example, I don't know, like a real estate focused impact investing fund or a donor advised fund or anything similar to that. Which I know that, just by doing real estate, if you do it with from the right place in your heart and everything, you are doing a service for a community, and that already it's amazing. But like, I was wondering if maybe there was something else as well. So yeah, would love to hear your thoughts.
Oh, yeah, absolutely. So I know for us, we are on the side of we change communities, especially on the value add apartments. Those are C blue collar workforce housing. And when we pick up the assets, they're like a subpar. But when we turn that asset around, there's a lot that goes in. We add events for the kids. We work with local nonprofits to give them support system to go to school. And if somebody gets in any kind of economic bias, we could help them out a little bit more. So we add value from that lens. Now, and most of the folks, almost everybody that I know outside that way, well, I mean, everybody that I know, I'm comfortable to say they have some kind of a nonprofit work, some way, shape, or form. So we add value in two ways: outside the real estate with our thing, and then inside the real estate from the value add operations. That how do we improve the local area, local community, so they can find a better spot to live to compare to. And Jasmine, you can talk about she. So we have our support for the she as well. That's one of the way we add value, right? And so I guess almost you guys know about she. So Jasmine, you want to talk a little bit about how she adds value? Scott. Okay.
Jasmine, you there?
Yeah, you there?
I don't know.
She's in
She's in the
she's
train.
not thinking. Okay, sounds good. So yes, we founded she from the very beginning to add value. Right, that's our way of adding the value as much as okay. Thank you. What
And then Tammy was asking about tools, and sorry you had a hard time getting in. Somehow Tammy sent me a text saying I don't qualify to join the meeting, and I'm like, there's got to be something wrong. And I sent her a link, and she got here. So, but you had a question about tools, so Sherrard geeks out when we talk about the tools. So
it's a lot. So let me share with you a little bit more what happens, right? So our data warehouse. We use Power BI, and that's the software. We do a lot of stuff that goes into the Power BI, mapping, remapping, on the other good stuff, and that's for the accounting and the purposes as well. As we do our fund, our data is going to be here as well, so we are auditable, right? If somebody wants to audit us or say, hey, what is your version of truth? This is the financial data that kind of comes from. From the market data valuation, we use RedIQ, we have CoStar, LoopNet, and we have an internally developed valuation model. We have two models. One is a custom made and one is the back of the envelope, one pager, and then whole deck out model. And the RedIQ has a bigger model as well. So those are all the tools. From the investor relations CRM, cash flow portal on high level, they all talk to each other. Asset management, accounting, and tax, it's Power BI, and we have an internally developed tool as well. Then process management and compliance, it's a high level, Monday. And so all of them are stacked together to create the portfolio, the tool stacked up.
And
Tammy,
it's quite interesting when we use the tools too, because deals will come back around and we save all of our research, all of our data, or other deals within that same geographic area may happen. So again, we've already done a lot and it's all saved there. I don't know how many deals now do we have saved, but it's a lot.
So that's how. So everything goes in like this video, it's on Zoom, it's gonna go to some other places, and then the Monday it's our deal flow. On the Monday happens, it goes to RedIQ. Then it comes to evaluation model. If we like it, then go to CoStar, go to LoopNet, put that model, that external information from Power BI. Then when you get into equity raising or communication, all of you guys in our CRM, and we send out text, and then we send out email. Everything happens in a high level, and this is very important as we grow. 506B versus 506C needs to be understood. So within all the investors, all the partners, or anybody who attended our events, we have to tag it, who is and where we had a meaningful conversation, where we didn't, or what type of conversation we had. So everything gets stamped here. Then the cash flow is the secure portal for money transaction. The fund gets in and out from cash flow portal. Communication gets in and out from high level. Information gets in and out from here. But all the financial gets stacked. Good question, Tammy. It's a loaded question.
Yeah.
Yeah.
Tom has a question. Go ahead.
Yes, Tom, go ahead.
Hey, Schreier and Trevor, great session here. So I did very fortunately get into the Massive Masters, so it's really life-changing, and I appreciate that program. So thank you very much. My question is about knowing your asset type. And you were saying, Schreier, take your time, plus your skills, and pick your asset. Let's see what's beyond multifamily. I love multifamily, but I find myself kind of going into an interest of land development, flex space, warehouse. I have background in healthcare administration, so, I can talk to those folks. I'm just not too sure how to branch out, or, I was hoping you or Trevor had a little survey I could take that would just say, okay, check, check, check. Okay, you go here. So any thoughts on that?
Fantastic question, right? So we spent some time together. So on that note, we do understand our so the reason we say there's a different taste is now number one, we want everybody to play, but if you just if you just hang out with the others who are playing the same game, right? So you kind of understand the terminology, to play, the players, and then when the time comes, you can go in. Land, I like it. It's a very calm play, very relaxed play. Upside is there. Downside is also there, right? Downside happens quickly before then we realize. Also, from the modeling side of underwriting side, multifamily is the simplest one to underwrite. And whoever masters multifamily underwriting, you can underwrite almost everything. So, which is also why we say, hey, learn the underwriting. We start with the multifamily, and then we get into a triple net, and then we get into the land development. Same model, different assumption, different play, different up and down revenue. Once you get a hold of the underwriting, by the time you'll do so many underwritings, you'll be in so many calls, you kind of get your call. It just happens, right? And it's happening, right? As you go through it, it's just happening, right? Within a month, you went from, I still remember when we met you, and now you are sending LOI and negotiating an LOI, and that's the first one. Once you send 10 or 20 or 30, you'll see the pattern slowly emerges. So give yourself a little bit more time. But on that note, keep your eyes and ears open, right? The land, what I say is land, you buy land as a land, just purely as a land. This is not the time you go out there, pay arm and a leg for it, and do developments and everything else, unless you have a know-how, right? Also, at the same time, we have some of those projects, the asset management call Thursday. I'll talk about some of the negotiating that's happening right now on our commercial space, and you'll see how the negotiating goes. Based on that framework, you underwriting multifamily, once you couple together, you get a better flavor of how to underwrite commercial. And over time, it's going to evolve as you.
Yeah.
So there's no checklist. You just got to hang out with us a little bit longer. That's it.
And another more interesting point too, buying value add multifamily, you're buying a business that is operating out of commercial real estate. So there is history, there is data. There are lots of neighborhood properties of similar or different vintage. So there's a lot of things that you can learn just by purely trying to understand the business, trying to understand the numbers. So it's a little more, I don't want to say it's simplistic, because that's a little bit where on development, you've got to know what are you buying, where you're buying, who could your customer be, what would your customer pay to be there? And there are a lot of variables, and you get one out of the 10 variables wrong, and the whole thing makes no sense. It's just you've gone and done, so it's very challenging. Because and again, doesn't mean it's impossible, because there's tons of people doing it, and you can do it well. The problem is you have to know what you don't know, because there's no number, unless there's been 4 industrial things built in the same area, you can actually get access to their real numbers. You can know what they paid for their land, what they paid for their development, what they're leasing for, who they're leasing to. And then again, there's a lot of supply and demand. And so there are a lot more variables. But again, once you understand those variables, but you need the basic foundation of kind of commercial real estate, which multifamily is, again, there's so much of it, and there's a lot of demand already, right? So hopefully that helps a bit.
Thank you.
Let me add another flavor to it. The asset class here that we are in control the most is the multifamily. We can change things every 30 days. We can change the price, we can change the look, we can change the feel. We are most in control as a sponsor as multifamily. Second most control will be your RV park and your self-storage and things like that. So that's your second most control that you have. Retail, not so much, because a lease is already in place, right? And industrial, similar thing. And the development is the riskiest, because you are projecting 3 years from now, who's going to show up for rent that you need to get paid. And in between, I'm exposed to interest rate, I'm exposed to war, I'm exposed to the dynamics inside the country, I'm exposed to the market, I'm exposed to everything. So which is why development is a mature play most of the folks, they'll grow up to be a developer. They'll own, they will do construction, then we go. From our side, we are cracking the industrial from the construction side. Don't know the rent, or we don't own a brokerage company, so I cannot control that side. Land, we cannot sort of know, but the construction angle, that is our play. So we're not going in just because we're going in to say, hey, we want to control the construction so that we have historical data. So Realty One partners, that's where they came in. We understand the construction here and the construction. We have 40 years of today. But multifamily is the purest way to go. Then the other two kind of show. We don't do hotels. That's not just our play. And we do RV park and mobile home park. And mobile home park, it's one of the toughest things. I have a guest right here. One of the top, RV park, and it's the coolest mobile home park. Very sticky tenants as you go, right? So that's okay. Melissa, you had a question? Your hands are raised.
Thank you. Sorry, I couldn't unmute for some reason. First and foremost, I just wanted to say thank you again because I keep learning so much. I thought we were like over with the session and the questions are great and I keep learning more. So thank you so much for all of the knowledge. And I wanted to ask something about the massive community because I heard someone told me that there was a free call on that it was on Mondays and then it switched to Thursdays and then I kind of went through the website, which by the way, you guys have an absolutely amazing website. I'm in marketing and I was just like, love this. But yeah, I was wondering if that community is still going on or not, if that college is still going on or not. So yeah.
Got it. So what, let me share my screen, then we'll talk about add some context to everybody, right? So what we're talking about here is here. So we have Massive Masters. That's our education platform. And this is where we kind of do deals together. So we have 14 calls a week, 15 calls a week. And on Monday, we have an operations call when we look at the macroeconomics and the microeconomics and share data to everybody. So that was an open call, but now that's a closed call only for the masters. On Monday, we share a lot of proprietary information, a lot of internal view of the world. So to add value to our masters platform, that happens in a month. We have 2 open calls, which is every Wednesday or every Tuesday, we have a call that is open to everybody else where we add value to the LP investors, or it's like today. And the next Tuesday, we have the she call. So we add value to our investors, our partners, that. And then if that jives from here and you say, you know what, team, I like which way it's going, and I want to be more active, or I want to be more actively passive. I want to know all those asset classes. Then just like Tom, I would say we have a 3 days seminar that we do. It's a Friday, Saturday, Sunday, 45, 50 people. We go through the whole intense learning after, and then we have an exit interview. From there, you decide if you want to join the masters or stay.
And that one's in person, so we'll have to wait till you visit us in Texas.
Yes, this is all in person.
One of your visits in Texas when we're having one of our classes.
I will for sure. Thank you so much for all of the knowledge and all of the free knowledge that you guys are giving. Like again, big shout out to She as well. I have been in more of their calls so far and absolutely amazing for anyone who hasn't been there before. And also a huge thank you for what you guys are also doing, what you mentioned you guys are doing with the kids and communities and stuff like that. Like, thank you so much for the work you're doing there. I'm currently working with like the Child Liberation Foundation as well, which if you know Mr. Paul Hutchinson, if you're interested in like funds and stuff like that, you probably know about it. So yeah, super grateful that you guys are doing that for kids.
He's amazing, yes. And just to give you an idea how dedicated I am to the She, that's me in a wig.
Absolutely love it.
I attended one of their events and Jasmine cried.
I did. I'm a crier.
I didn't mean to make her cry, but it was cries of happiness.
Yes, of course.
Awesome. So again, we do this every other Tuesday, and then every other Tuesday is the She. I do join the She once in a while if it's a speaker that I put my background up, so at least I almost fit in. So, but yeah, always a lot of amazing content. And our ask always is, if we brought you some value today, come back in 2 weeks and invite a friend. Our goal is to spread the word, to talk about investing, and to do different things. So, Tony from Portland, great goodness, thanks for joining.
Tony, not sure when you joined in, but feel free to ask questions. This is the Q&A. All questions.
Thank you.
Questions.
Thank you, guys. First time here. I was very impressed with all the information. I do underwritings for multifamily, and I'm glad you mentioned that because this is something I'm very motivated. As a matter of fact, I just got a deal in St. Louis, Missouri, 332 units, 50,000 a door. It's upside down. The problem is the what you call that, the management is 65% expenses, which is no good. But yeah, I would like to bring something like that next time.
That sounds good. So I'll give you an example how. Let's use that as an example, right? What is
Yeah.
so I'm sharing our this is our dashboard. Again, I'm sharing with everybody the amount of deal that goes through our pipeline and that we manage at all time. You can see on the right side, just in last 2 months, we underwrote about 300 properties.
Wow.
So now the
Wow.
question is, when we look at a deal like that, we tend to say we have 5 minutes, if not less, to decide whether it's a go no go. And the first thing we
Yeah.
ask, okay, that deal, but first thing is the location, then the the submarket, and then the property. We have some internal KPI. We could tell whether deal works or doesn't work. And then we look at operational side. Hey, who's going to run the asset? How they're going to run it? What's the resume? Have they been there? We have a whole source of flow that we kind of go through. And then we look at balance sheet perspective, then we look at equity perspective. And all of those things happen really, really quick for us. And this is the way we kind of measure it from average day, from the first time we get an email to that decision, it's about a day and a half. The things tend to move really quick through us.
Yeah.
So when you look at it, you have one deal. We're asking the question, you live in Portland.
Yes.
And this is in a different state. And it's a
Correct.
very gentle state. My question is, why do you think the deal is good? Just because beyond whatever everybody else. Remember that the whole edge, right? What is the competitive edge? What gets you the special view that I can see?
Yeah,
Then
it's
we
in
kind of practice that.
1980s. Yeah, 1980s. I have partners, a network. So I send my partner to take a video and check the property,
Yeah.
and he says that all you need is approximately 5,000 per unit to improve,
Right.
and it's on their rent. Like average is 820 about, and the competition around. No better than these are 1150.
So that's fantastic. Then the question is, why not competition buying? Why it came so far away to me? Right?
Yeah,
It's a good question.
we asked the broker. The broker said that the owner has a portfolio, class A. This is the only one that is bad management, and he just don't want to deal with that anymore.
Yeah. Okay.
It's not on the market yet.
Look, let us be real, right? If broker called you so far away from the state, he talked to everybody in the local neighborhood, he talked to everybody in the state he ever sold the property, then he went out of state. Nothing is our market. Brokers are great at what they do. We are decent at what we do. So no brokers, there's no way a broker is gonna call me to get me just one deal, even though I bought so many of them. They're gonna call all of my friends that I hang out, all of the local property owners next door, recently bought it. And as a part of that, further you live, less properties you have, you got less of a ranking. By the time you go through the ranking process, you'll get a deal like that. So broker can't
So
sell
we
the
don't
deal.
know the story. Yeah, that's what I'm saying.
Thank you.
Correct.
Now, right.
Correct.
Yes, the broker, why'd you call me? Just tell him, why'd you call me for? I own
Correct.
assets. Then you'll see the real life conversation will catch up, right? And that's what the beauty is. When you go in by yourself, it's tough. But hypothetically, you and I go, broker, you shoot your shot, I shoot my shot, right? Quit wasting time. Give me the download.
Perfect. Thank you.
That's the beauty of hanging out with the team, right? So good. Thank you, Tony. I appreciate underwriting. We underwrote a deal now. Cool.
Awesome.
Thank you. Thank you,
everybody. Again, see you in 2 weeks. Bring a friend. We want to grow this back when we were in our heyday. We had, I think 119 was the most we had. We
give
got
us a month.
give us a month back up and get there. So if everybody shows back up with a friend, and we're looking forward to seeing everybody.
Thank you.
Thanks, Gerard.
Thank you. Really appreciate it.
Good to see everybody.
Cheers.